Not a great start to the week for Japan, as the world's third largest economy has today posted the smallest current account on record. Japan economist Marcel Thieliant of Capital Economics is on the line now. Marcel, policymakers had expected a falling yen to support exports and the greater economy. With this clearly not the case, what did policymakers miss from Japan's broader economic picture?
The current account is kept in deficit for a few reasons, and one is actually the weaker yen, because the weaker yen is actually raising the costs of imports more than it's raising export revenues. So this is the reason why basically the trade deficit has widened in recent months. But also it has relatively little impact on export volumes. And here the main reason is that most of the exports are actually invoiced in foreign currency, and exporters have not lowered prices very much. So basically the boost to competitiveness for these exporters has been much smaller than is generally believed. And the other factor is just the consumption tax hike. So consumers are bringing forward demand, and this is currently boosting the deficit. So we think the second factor, basically the strong demand currently, will basically drop out of the picture from April when the tax will be raised. But since we expect further weakness in the yen, this will continue to keep the trade deficit deeply in the red.
Consumer confidence also weakened unexpectedly in December. While emerging market turmoil is considered to be taking its toll on Japan, does this domestic data not suggest that perhaps the problems lie more internally?
The emerging market turmoil should have relatively little impact in terms of the aggregate demand for Japan, because most of the countries that are currently facing turmoil, they trade very little with Japan, so the impact on the export front should be quite small. The bigger thing is through the financial markets channel, because we've seen quite a bit of safe haven demand for the yen, so the yen has strengthened, and this will obviously make it more difficult for the Bank of Japan to reach the inflation target. But as you said, there are clearly problems now emerging internally. The weakening sentiment. I mean, these surveys are basically all asking about the outlook, and the outlook has just weakened. And this is unsurprising because of the consumption tax hike. The latest data that asks more about what's currently happening, for example, the manufacturing PMI, which was released last week, was actually very strong. So currently things are still strong, but the outlook doesn't look as nice anymore.
If the Bank of Japan does stand ready to extend Abenomics, as was reported last week, is today's negative data indicative of a potential timeline on this matter? Can we expect a greater sense of urgency from the central bank?
It's a bit hard to say, but I would generally think that this is all in line with their forecast. I mean, they've been pretty clear that they do expect demand to be very weak in the second quarter after the consumption tax hike. So I guess for now, it's all in line with their expectations. We will really have to see how weak the economy really will be. So we really have to see the hard data, industrial production, retail sales after April. And we also think that the Bank of Japan will wait for this data to be published. So that makes easing, at least in the next few months, quite unlikely. One possibility would be July, when they have when all these data will be available. But we think it will be more likely October, because by then they can really judge if they have or they have not failed on their 2-year horizon, which basically ends at the beginning of next year.
And lastly, looking at currency response, dollar-yen was up during today's Asian session. Is this move likely to extend into European trading, or will the present bearish sentiment prevail in your view?
We do expect the yen to weaken again in the next few months, simply because of the relative outlook for monetary policy, with the Bank of Japan likely to continue easing, whereas the Fed is now basically withdrawing some of its stimulus. This clearly argues in favor of a weaker yen, and as the current negative sentiment from the emerging market turmoil subsides, the yen should resume its weakening trend.
Marcel, many thanks for your comments. Want to know what else is on the agenda this week? Then stay tuned, as Ben Jones will be bringing you the Week Ahead interview. Thanks for watching, and goodbye.